Three best ETFs: SCHD, VOO, QQQ. Here are three of the best ETFs for long-term investing, and these, in my opinion, are the kings in their respective categories. SCHD for long-term investing, QQQ for you growth investors, and Vanguard's VOO for a blend of both growth and value in the most well-known and popular ETF of all time. Now, in this video, I'm going to be settling the debate and answering the most commonly asked question: what's the best ETF out of these three for long-term investing? I'm going to be scoring these three ETFs based on a point system based on various categories such as performance over the last 5 and 10 years, including all-time returns, dividend yield, expense ratio, diversification, risk, the best and worst year of returns, a bonus category. Whichever ETF wins out of these respective categories will get a point tied to its score, and the ETF with the most points at the end of this video will win this contest. I'll even include some honorable mention ETFs at the end of this competition that can be a direct replacement or new replacement for either SCHD, VOO, or QQQ. So without further ado, let's get started. Vanguard S&P 500 ETF VOO Review. The Vanguard S&P 500 ETF VOO is one of the most well-known and widely used broad market ETFs, designed for investors seeking stable, long-term growth through diversification and consistency. VOO tracks the S&P 500 index, which consists of 500 of the largest publicly traded U.S. companies across various sectors, making it an excellent representation of the overall U.S. stock market. This ETF includes industry leaders like Apple, Microsoft, Amazon, Berkshire Hathaway, and Tesla, providing investors with exposure to well-established businesses that have a history of strong financial performance. One of the primary reasons VOO is favored by long-term investors is its historical reliability. Over the past decades, the S&P 500 has delivered consistent average annual returns of around 8 to 10%, making it one of the most effective ways to build wealth over time. Unlike sector-focused ETFs like QQQ, which are more volatile, VOO offers a balanced mix of growth and stability, making it suitable for both conservative and aggressive investors. Another major advantage of VOO is its low expense ratio of just 0.03%, making it one of the cheapest ETFs available. This ensures that investors keep more of their returns rather than paying high management fees. Additionally, VOO provides a modest dividend yield of around 1.3%, which adds passive income to investors' portfolios while still allowing for strong capital appreciation. VOO is also highly diversified across multiple sectors, including technology, healthcare, financials, consumer discretionary, and industrials, reducing overall risk compared to sector-specific ETFs like QQQ. While it may not offer the extreme growth potential of QQQ, it is considered a core holding for many investors due to its low risk, steady returns, and ability to perform well over long periods. For those looking for a set-it-and-forget-it investment, VOO is an ideal choice. It aligns with Warren Buffett's investment philosophy, as he has often recommended the S&P 500 as the best long-term investment for most people. Whether you're a beginner investor or a seasoned pro, VOO is a top-tier ETF that offers a balance of growth, income, and diversification, making it a strong foundation for any long-term portfolio. SCHD ETF Review. The Schwab U.S. Dividend Equity ETF, SCHD, is a well-known dividend-focused ETF designed for investors seeking both steady income and long-term capital appreciation. It tracks the Dow Jones U.S. Dividend 100 Index, which consists of 100 high-quality U.S. companies with a strong history of paying consistent and growing dividends. To be included in the index, companies must have a minimum 10-year history of dividend payments, along with strong financial health and profitability metrics. This ensures that SCHD invests in stable, well-established businesses that prioritize returning value to shareholders through dividends. One of the key reasons for SCHD's popularity is its attractive dividend yield, typically around 3.3% to 3.7%, making it an appealing choice for passive income investors. In addition to providing solid dividend payouts, SCHD also boasts strong dividend growth, with an average annual increase of 10% or more over the past decade. This makes it an excellent option for investors looking for both income and inflation protection. Moreover, SCHD has a low expense ratio of just 0.06%, meaning investors can keep more of their returns instead of paying high management fees. SCHD also offers broad sector diversification, with holdings spread across financials, healthcare, and consumer defensive sectors, which are known for their stability. Unlike technology-heavy ETFs like QQQ, SCHD focuses on companies that are less volatile and more recession-resistant, making it a great complement to a tech-heavy portfolio. While it is primarily a dividend-focused ETF, SCHD has also delivered strong total returns over time, benefiting investors through both capital appreciation and dividend income. With its combination of high-quality holdings, steady dividend growth, and low fees, SCHD remains one of the best dividend ETFs for long-term investing. QQQ ETF Review, QQQM. The Invesco Q ETF, QQQ, is one of the most popular and best-performing growth ETFs, designed for investors looking to capitalize on the potential of the technology and innovation sectors. QQQ tracks the NASDAQ 100 index, which includes 100 of the largest non-financial companies listed on the NASDAQ stock market. This means the fund is heavily weighted toward tech giants such as Apple, Microsoft, Amazon, Nvidia, and Google, making it an attractive option for investors seeking exposure to cutting-edge industries like artificial intelligence, cloud computing, and e-commerce. One of QQQ's biggest strengths is its historical outperformance compared to other major ETFs. Over the past 10 years, QQQ has delivered returns exceeding 450%, significantly beating the S&P 500, VOO, and SCHD in total growth. This exceptional performance is driven by its focus on high-growth companies that continuously expand and innovate. However, with this high-growth potential comes higher volatility, as technology stocks tend to experience larger price swings during economic downturns or market corrections. QQQ also has a relatively low dividend yield, typically around 0.5% to 0.7%, since most of its holdings reinvest profits into expansion rather than paying dividends. The expense ratio for QQQ stands at 0.20%, which is higher than broad market ETFs like VOO, 0.03%, but reasonable given its specialized focus on high-growth stocks. Investors looking for a lower-cost alternative to QQQ may consider QQQM, which has an expense ratio of 0.15% but follows the exact same index. While QQQ is less diversified compared to the S&P 500 ETF VOO, it still provides exposure to other sectors such as healthcare and consumer discretionary, though technology remains dominant. Given its strong historical performance, high long-term growth potential, and exposure to some of the most innovative companies in the world, QQQ is an excellent choice for investors looking to maximize capital appreciation over the long term. However, it is best suited for those with a higher risk tolerance who can withstand market fluctuations in pursuit of higher returns. Performance comparison. A quick snapshot of the performance of these three ETFs with dividends reinvested based on Seeking Alpha data. Over the past 5 years, QQQ has absolutely demolished all the other ETFs in terms of returns, with over 150% returns, followed by VOO in second place and SCHD in third place. So QQQ takes the lead with the first point added to its score. Over the past 10 years, QQQ continues to be the king of the hill at over 450% gains, followed by VOO in second place and SCHD in third place. So QQQ gets another point added to its score. In terms of all-time performance, VOO has been around since 2010 and SCHD has been around since 2011, while QQQ has existed since 1999. Since QQQ has a longer track record, it has an advantage in terms of time horizon, making a fair comparison difficult. To balance this, I included the S&P 500 index in the data as a replacement for VOO, and in that case, the S&P 500 comes out on top with over 1,000% returns, followed by QQQ in second place and SCHD in third place. Since the data is slightly skewed, VOO gets half a point. Dividend yield comparison. Looking at dividend yields, QQQ has the lowest dividend yield at 0.59%. VOO comes in second place with a 1.34% dividend yield. The winner of the dividend yield category is SCHD, with the highest dividend yield of 3.37%, making it a great option for passive income. SCHD gets its first point on the board. Expense ratio comparison. Since we want to minimize expenses, here's how they compare. QQQ has the highest expense ratio at 0.2%, but QQQM, its younger twin brother, has a lower expense ratio of 0.15%. SCHD comes in second place with a low expense ratio. The winner of this category is VOO, with an expense ratio of just 0.03%, so VOO gets another full point. Diversification comparison. Diversification helps spread risk across multiple sectors. SCHD has over 100 holdings with financials, healthcare, and consumer defensive as the top three sectors. SCHD gets a point. VOO has 500 plus companies, making it highly diversified. Technology leads with 30%, followed by healthcare and financials. VOO gets another point. QQQ has 100 plus holdings, but it's highly concentrated in technology, 50% plus, making it riskier. QQQ gets half a point. Risk and volatility. SCHD wins for having the lowest standard deviation, meaning it is the least volatile. SCHD gets another point. QQQ has the highest standard deviation, meaning higher volatility. Based on Seeking Alpha's risk scorecard, VOO gets an A+, SCHD gets a B-, and QQQ gets a C+. VOO gets another point. Best and worst year performance. Best year, QQQ had a 54% return, so QQQ gets a point. Worst year, SCHD performed the best, dropping only 5.1%, so SCHD gets a point. Long-term growth comparison, $100,000 investment. QQQ had the highest returns, turning $100,000 into nearly $1 million since 2010, with dividends reinvested. QQQ gets 2 points. Bonus category, Best Set It and Forget It ETF. For a long-term reliable ETF, Warren Buffett's favorite ETF is the S&P 500, VOO. VOO gets a point. Final score and winner. Adding up the points, QQQ, 5.5 points, winner. VOO, 4.5 points, second place. SCHD, 4 points, third place. While QQQ won based on historical performance, past performance doesn't guarantee future success. SCHD is great for dividends, and VOO is a well-balanced choice. You can even hold all three ETFs in a portfolio and adjust based on your investing style. Honorable mention ETFs, SCHD alternatives, DGRW iShares, VYM Vanguard, VIG Vanguard. QQQ alternatives, VGT Vanguard, FTEC Fidelity, XLK SPDR, VUG Vanguard, QQQM Invesco. VOO alternatives, VTI Vanguard, VT Vanguard. That's it for this video. If you enjoyed it, please like, comment, and subscribe. Let me know what ETFs you're investing in for the long term.